And if you're going to make money, it's probably going to be quite slow. So you've got to try and push. You've got to try and push as a probability distribution. You've got to try and push it through here, because unless you can get beyond this flip of a coin, you're never going to make any money. You're never going to make any money. So when you add in value, when you add in narratives, when you add in, like, for example, I've just taken another long gold trade. I don't know who's with me on that trade, but I took another long gold trade. I've just made $1,500 on an 8 lot. Very, very easy. Lean at 88, 88.4, 88.5, 88.6. Did anybody take it? So we made a couple $100 on the first one. We've got another lean on the on the second one, and we're going to see if we can get. Well, we've got to stop at break even. Obviously, that's not too difficult. Yeah. Well, I mean, obviously the lean should have been 88.7s, 88.8. So you're a couple of ticks off the marker there, David. But that's okay. A couple of ticks is okay. I mean, if you know, but you just got to get better, haven't you? I mean, it's as simple as that. You've got to get tighter to that lean as much as possible. But you've got to start somewhere. You've got to start building into those as good leans and take advantage. So we've got to try and push the probabilities to the right here. We've got to try and make sure that when we're taking a trade, that the skew starts working for us, isn't it? That the downside is very, very limited. The upside potentially has an awful lot, and you know, we should be able to start putting our probability distributions into something like that, where in the vast majority of occasions, the trade can, you know, the vast majority of occasions we'll make some good money as we go through the 50, because remember, this is a 50-50 chance. So I mean, a 50-50 chance of us, you know, getting into the money. We've got a lot of probability distribution to the positive and not so much the negative. And that's, we still have negative, remember, guys. It's not an arbitrage. An arbitrage would look like this, wouldn't it? If I was to draw an arbitrage distribution, it would look like this. It probably wouldn't look like that, actually, at all, would it? If I was to do an arbitrage, the distribution would look like this. What the hell is that? But anyway, it doesn't make any difference. It was a draw on anyway. That's what the arbitrage would look like. So you can obviously start looking at the probability distribution on an arbitrage, that it kind of goes up very, very quickly. It never has any negative at all, because obviously it's an arbitrage, so it doesn't have any negative. The positive is small but it's always 100%. So that's what we understand, isn't it?